Great. Steffen, thank you for joining us today at the Bonding Curve Research Group. We've got a presentation on Gyroscope today, the Gyroscope stablecoin system. And with that, I'm going to hand it over to you.
Yeah, great. Thanks a lot. Thanks a lot for having me. Right. So what I want to do today is give you an overview of what Gyroscope is, what all the components of the system are, and then do a deep dive into one component that is related to bonding curves. So the kind of ideology we gave ourselves is revolutionary resilience. Let's put risk control on autopilot, at least as far as we can. And Gyroscope is a system that consists of two components. The first one is a stablecoin that launched last week. We call it GYD or Gyro Dollar. And it's a reserve-backed system with a diversified reserve that also generates safe yield. And the other component is a liquidity network of AMMs that we designed called ECLPs or Elliptic Concentrated Liquidity Pools. The elliptic in there is like people always say like, oh, it's like elliptic curve cryptography, right? Like, no, it's because we use an ellipse model. It's like a geometric thing. And the feature, the reason we made it is we wanted to have some very capital efficient and very configurable pools. So basically, this gives you a distribution of liquidity that you can adjust very finely to the assets that are involved. And now these two components help each other out in different ways. First, what the stablecoin does is that it provides a central asset for the liquidity network to settle transactions. And what the liquidity network does for the stablecoin is it creates an efficient secondary market. And the LP share also serves as collateral for the stablecoin. Of course, not LP shares of the secondary market of the stablecoin against itself. That would be a bit recursive. But the stablecoin uses LP shares in other asset pairs, and part of that acts as collateral for the stablecoin. What we've also planned in the future is that you can actually use these in other pairs that are not USD pegged, and then you can use that as collateral and get over collateralized loans on that. I should probably say a few words about myself or why you should listen to me. So my background is in math. I did a math undergrad. I then did my PhD at the intersection of finance and computer science. So that was in the field of algorithmic game theory, or also did a postdoc in there, or more like broader economic design. So kind of a type of economic theory with the goal of designing markets. And then in 2021, I became a co-founder and head of research at Gyroscope, and I helped design most of the stability mechanisms you're going to see today. Right, I should probably give you an outline. So the group was very kind and invited me to give a whole talk series. Today, I'm going to talk about GYD mostly, how we designed it, and then do this deep dive that I mentioned. In the next talk, I want to focus on ECLPs and talk about like what these pools are, how they work internally, why I hope I can convince you it's a good design. And I also want to give you some modeling tools that we use to design and calibrate them. And these can actually be applied to many different AMMs, not just ECLPs. And then potentially a third talk could be about an Oracle system that we have designed, which we call the consolidated price feed, governance mechanisms, other stability mechanisms, and so on, everything else that makes the system work. In this talk, I want to do like 3 parts. All right, and like please interrupt me if you have like questions, right? This is like a small group. I think it's totally fine to do this.
I have a quick question,
yeah,
Steffen.
Please.
I'm curious, where did you do your PhD? That sounds like a really good program.
University of Zurich. I did my PhD at the University of Zurich. So in Zurich, there are these 2 universities, right? There's ETH, which is the famous technical university, and then there's University of Zurich, which has a broader, let's say, wider focus. And the computer science program at the University of Zurich is focused on intersections of computer science with other things, among classical computer science, of course. And I did my PhD at the group of Sven Zeuken, which focuses on market design.
Thanks.
Sure. Right, where was I? Right, I want to talk about GYD. We're gonna start with why, like any good speaker. Then talk about the what. Very briefly, I'm gonna very briefly talk about the launch because it has like a few special aspects. And then finally, I want to do the deep dive into the thing called the dynamic stability mechanism, which is essentially a dynamic bonding curve mechanism to react to under collateralization of the system. And the system does this autonomously. Right, so why GYD? GYD is a non-custodial. By this, I mean you don't have to like trust anyone. It's fully on-chain, diversified and reserve-backed stablecoin. And let me like briefly, like this is going to be shorter than it looks, but let me briefly go into like why we even felt this was necessary. And there are like these 5 points that we observed in other stablecoin designs. The first one is risk tended to be pretty concentrated. That's what we felt. Either you might have a stablecoin that only has one collateral, or you have multiple collaterals, but they are not properly isolated from each other, so that one failed collateral still means a failed stablecoin. Governance is too slow. I think that decentralized governance is great for making long-term strategic decisions about where a system is supposed to go, but really bad if you need to fix something really quick in a crisis and react. And so what I'm gonna show you is that the system should react autonomously to as much as possible, and so we leave to governance the strategic decisions. Scale is something else. Supply and demand of a stablecoin, essentially in these, let's say, more complex, more algorithmic systems are sometimes not linked directly. So you can have an imbalance there. Fragile Oracle systems. Our systems, like many other, relies on Oracle prices to price the underlying assets. But often what people do is they just use Chainlink, and that is a bit fragile. And then we have this problem of liquidity dry up, which happened during turmoil, and on-chain risk management being difficult for liquidity providers. So I very briefly, it's only one slide per point. Risk too concentrated. That's kind of a core principle. We want a diversified reserve, and I'm going to show you what this looks like at launch. So this can be changed by governance over time, can be extended, but this is what it looks like currently. The system has a reserve that's centrally managed. People can mint and redeem against this reserve. And it has a balanced portfolio of different underlying assets. These are all stablecoin invested into different strategies. And right now, this is USDC in Flux, USDT in Aave, SDAI, so that's DAI and the DAI savings rate, and then a pool of Curve USD and USD. And so the yield strategy there is spot fees. And the system centrally manages access to this reserve, which I mean, it's making sure that the reserve doesn't become unbalanced, for example. So you cannot, let's say, hugely expand the system and make it only consist of USDC. That's something that will say that's not something you can do. Governance being too slow and scaling. So scaling is kind of solved by the whole thing being mint and redeem and reserve backed. Governance being too slow is the main mechanism I want to talk about. This is going to be what I call a dynamic stability mechanism. And essentially it gives some programmatic risk control. And actually I want to skip this because I'm going to talk about it in much more detail later. The Oracle system, what we said for Gyroscope is, okay, the system needs some prices, needs to pull prices from somewhere. So what the system does is it pulls prices from Chainlink, but it takes them as essentially a possible solution to a system of equations. And that system of equations is defined by the interconnections between different on-chain trading pools. So essentially what the system does is you get the vector of prices. The system does, oh, if this vector of price is correct, then I can also compute relative prices, and then it will compare that to certain on-chain DEX pools. And if everything is kind of approximately in order, then this is a normal state. And if it's not, then the system says, well, this is either this is an extremely unusual market state. I'm going to neurotically wiggle my mouse pointer just in case that helps. Amazing, I love it. Great, where was I? Yeah, so essentially what the system will do is it gets this vector of possible prices and it checks that against what is going on in the on-chain market. And if it notices some discrepancy, it will flag that as either an unusual market state or could even possibly be an oracle manipulation. Of course, the system has no way to know this, but it's going to flag. And then we have this whole issue of liquidity, and this is of course where right. And so of course with the whole issue of liquidity, this is where the ECLPs come into play again. And actually we designed 3 different pools. The ECLPs just happen to be the ones we are using the most by far. We also have different ones with different properties. We call these 2 CLPs and 3 CLPs. The kind of problem I was talking about was that decentralized liquidity has a certain tendency to dry up during turmoil. And so having a liquidity network is really good for 2 reasons. First of all, we can have the stablecoin GYD as a central asset, and then you can get efficient swaps that settle via GYD versus other pairs. And the other thing is that with these separate pools, DPEGs in these different assets are isolated from each other because you have separate pools that connect GYD to every other asset. And so you get some redundancy for that. This is some detail about the ECLP. So essentially what we do is we have a liquidity curve that's shaped, and then we apply concentrated liquidity. And that way, essentially you can cut out the price of the trading curve that is useful, that provides liquidity within useful prices, and put all of the liquidity there and concentrate it at that point. And then you get high liquidity in the part of the price curve that you actually care about. And then in some pools, so we have deployed a few of them before the launch of the stablecoin. In some pools, you get like 28% more capital efficiency than existing solutions like StableSwap or something like that.
Wow.
Otherwise, it's similar liquidity distribution. Of course, this depends on what exactly you want, but it tends to be in that ballpark. Right. So let me tell you about the launch a little bit. So at launch, if you go to gyro.finance and you look at Gyroscope, what you're going to see is that GYD is currently actually backed by 2 sources of collateral. The first one is the diversified reserve that I showed to you. That the weighting is currently like this, or I think this is the target weighting. And the second one is a special mechanism that that the system had for launch, which we call the bootstrapping pool. And the bootstrapping pool is an ECLP with a pretty tight price range. Here you see the curve of what's basically liquidity, so liquidity on the y-axis, price on the x-axis, and prices in basis points from 1. So this is exactly 1-to-1. And then here we have plus 15 basis points, which is still pretty tight. And the reason why we set up this bootstrapping pool, because we thought, well, at the start of the system, it's somewhat complicated to interact with this diversified reserve. Maybe not everyone wants to do it, and it's much easier for people if they can just go and buy GYD against some other asset. And so we created this. This is something that contains 20 million pre-minted GYD. And when people purchase GYD with the other asset is SDI. When they purchase it with SDI, the SDI acts as collateral against the GYD. This is something temporary. You shouldn't do this like permanently and at large scale because it kind of eliminates. I mean, it doesn't have all of these nice other properties like a central access, and then you have like balancing and these kinds of things. But it has, of course, the advantage of being very easy to use. TVL-wise, this is a chart of GYD supply. I made this a few days ago. I think now it's like a little bit more, like 3-point-something million GYD. System launched last Thursday, December 7th. No, Thursday a week ago. And got to some scale pretty quickly. On last Wednesday, we released the first part of the governance system. So the governance system has these different vaults that represent different stakeholders in the system. The first ones were deployed. The next ones are going to be deployed like pretty soon, a couple of weeks maybe. Right now, the ECLPs that map an asset against GYD have about 6 million in TVL. We have some other ECLPs that we deployed earlier, and they have about 30 million TVL. These are mostly pairs against liquid staking tokens, or something like Wrap Stake ETH against Wrap, or something like that. Right, and so right now we got some balancer rewards. So that's why if you deposit into these pools now, the APR is around 30%, at least for these two. Again, so this might be like a little bit outdated, but not too much. And so there's still some LPing that people can do. And this is the last one about GYD before I get like a little bit deeper into the theory that lies behind one of the mechanisms. We have some upcoming features planned. The first one is a feature by which the protocol would share the yield on its reserve assets with certain parties, probably LPs. We have some ECLPs planned that we want to deploy to complete the secondary market for GYD. More governance vaults. There is an upcoming launch of the governance token of the system. And I said that the governance system has these different vaults that represent different stakeholders, and the governance token will be represented in one of these vaults. So it's part of the governance system, important part, but not everything. And then a little bit further out, what we also want to do is implement an over-collateralized loan mechanism to mint GYD as another option, where you can have these over-collateralized loans like in the original version of DAI or Liquidity or something like that. Right. Like at this point, is there anything that you want to go deeper into? Any questions you want to ask? Because otherwise I'm going to go deeper.
I have a question here. You mentioned about the over-collateralized loans. Do you see a way of under-collateralizing loans, like other than the, I guess, the DAI system, how the maker does it? Like, do you have a
Sorry, what are you saying?
about
Over-collateralizing or under-collateralizing?
Under-collateralizing.
Under-collateralizing.
Because I believe that's the one major issue with the DeFi and crypto adoption is that we don't have under-collateralized loans, identity management and whatnot.
Yeah, that's a great question. I guess if you want to under-collateralize loans, you need some way of recourse, and you need some way of identity, right? Because I mean, like a bank loan is basically you have like some legal recourse, and that's why you can under-collateralize it. I guess if you can put something like reputation on the line, which I mean, if you really want to see it that way, maybe that's still over-collateralized, but the asset that you're over-collateralizing with is like your reputation or something like that. I guess that can work. I know that there are these protocols like Goldfinch that I think essentially do that. Yeah. And other than that, I guess you can have, I mean, I guess the like trivial answer to the question is to have an adapter similar to tokenization of stocks. I guess you can have also tokenization of loans. And then someone has to make sure you have that legal recourse and they're actually going to exercise it if they need to, and that kind of stuff. I guess that could work. I guess tokenized T-bills technically are actually that, but in a like very special case. Yeah, these are my thoughts on that. MD, you had a question? You're raising your hand.
Yeah, thanks. Are you able to share like a compare and contrast to your system and Frax's system? Are you familiar with Frax's stable system?
Yeah, sure.
Or even as a follow-up, like Prisma has launched their MK USD. So those are two. Anyways, if you could comment, and if you don't, it's all good.
No, definitely.
Thanks a lot for the talk. Also.
Sure. So Frax, I would say the answer is that GYD is actually fully collateralized and aims to be over collateralized, like the yields over collateralizing the system. Frax has this partial collateralization with its own governance token, which I think is extremely risky. Other than that, we have this mechanism that ensures balance of this portfolio. So that is certainly one aspect. If you come to the system and you want to mint against one of these vaults and it's approximately balanced, you can. If you want to mint so large amounts against them that would unbalance the system, then at some point the system said that's just no. So there's a check there. There are other mechanisms. I guess kind of the more you let me talk, the more kind of detailed it becomes. There are more other mechanisms that protect against unknown unknowns, for example. So there's a system that measures inflow and outflow into these vaults and detects when something is extremely unusual, and then either flags that or blocks that by default. There's the whole mechanism I'm going to talk about, which is this dynamic stability mechanism, by which the system autonomously responds to under collateralization. And I think that's pretty unique about Gyroscope. Jeff? Oh, sorry, I can't hear you. I can't hear you. You're unmuted, I think, but I can't hear you.
Yes,
oh,
there we go.
Yeah.
My question was actually about this slide, so thanks for flipping back. I'm curious, these are two separate mechanisms for minting.
Right.
I'm trying to remember what it's called now. So in a multi-token pool, where you can enter just a single or remove just a single asset. So, or I guess, so your bootstrapping pool is with SDAI, but SDAI is not in one of your diversified reserve pools?
I mean, it is actually, it is. But it doesn't matter. The overlap doesn't matter. The kind of question is like, how do these things like even interact? Is that like...
Yeah, or I was just curious if the bootstrapping pool, so if I put SDAI in and then mint GYD from the pool, is it different from putting SDAI into one of the baskets and it basically like rebalancing the reserve collateral? So if I put in 1 million SDAI, then it would turn it into 30% SDAI, 30% Frax, etc. But the GYD would then be backed by all of them, or does it not really have that? I guess that's what you're going to talk about with the dynamic stability mechanism as well, I guess.
So the dynamic stability mechanism is a little bit about something else. So, I mean, thanks for bringing up the question. So the split between the diversified reserve and the bootstrapping pool makes no attempt of keeping any balance or anything like that. But the amount of GYD in the bootstrapping pool is capped. So at some point, you just cannot mint from the bootstrapping pool anymore unless someone comes as a liquidity provider and puts some in there or sells GYD to the bootstrapping pool. Of course, you can do that, but it's somehow not the job of the system anymore at that point. I mean, people can do with their tokens whatever they want. So that was like the first part. As I said, that's also because the way we think about it, this bootstrapping pool is a temporary tool to kind of kick off the system. And we actually expect that governance is going to essentially unroll this bootstrapping pool once the system's off the ground, once people are familiar with using this, let's say, primary mechanism. And what you can then do is governance can take the SDAI that are here and add them to the reserve in some way, or they could swap them to get a more balanced reserve composition or something like that. But that would be like a one-time action. How are the two related? So you can, let's say what you can do is you can go like in a circle. So you can mint from the reserve, take the GYD and sell them to the bootstrapping pool. I guess in some situations that could actually be an arbitrage. So you're absolutely free to do that. The only thing that you cannot do is if you buy GYD from the bootstrapping pool, but the reserve is actually not large enough to redeem them, you can't redeem them in the reserve. You can only redeem them in the bootstrapping pool because there's just no assets there. And actually, if you look at the system currently, this is actually what the system looks like. So the reserve is very small because most people just took the easiest route and just bought GYD from the pool. Yeah, right. Right, I think the third question was, does the system rebalance itself? And here I'm focusing on the diversified reserve. There's currently no attempt. This could be built in, but it's relatively complex because ideally you also want to route these trades optimally. So I think probably, I mean, maybe you're going to build it eventually, but my intuition right now is that probably the system shouldn't do this autonomously, but should instead set incentives for people to do this. Currently, the only incentive, if you will, is that the system at some point doesn't allow you to use one asset anymore if it's overweight, so you have to use another one. I guess there could be something like a dynamic fee or something like that to actually create incentives for rebalancing, for rebalance. Awesome. Now let me do my deep dive. And the thing I want to look at is the mechanism that kicks in case of under-collateralization. And again, for this part of the talk, I'm assuming basically that the bootstrapping pool doesn't exist because the system doesn't manage it centrally. So we're only thinking about the diversified reserve here. And so, of course, like a reserve-backed stablecoin, I want to take like a little bit of a step back. A reserve-backed stablecoin has some assets, and then you have a primary market mechanism, and people can come there, put the assets in, get the stablecoin out, or vice versa. Now, in normal times, the system is at least 100% collateralized, and what this means is that the whole thing is very simple. When they want to mint, you price the assets, they put them in. When they want to redeem, you put a unit of stablecoin in, and you get $1 of assets back. And of course, that's like already complicated, but let's assume we can do it, so there doesn't have to be anything else there. The whole thing gets a little bit tricky if, let's say, your system is collateralized, over-collateralized, but not all of these assets are liquid. So not all of these assets are useful to give to people when you're not able to give to people, something like this. And then, of course, there are also crises where the system is under-collateralized. And here, what we felt very strongly is that the system should respond to this autonomously and do something useful. And I'm gonna tell you what it's gonna do. Kind of the goal of this is we were looking at DAI and the peg stability mechanism, and in a way you can think about Gyroscope's diversified reserve as a peg stability mechanism 2.0, where the strategies in the different vaults or asset classes are coordinated with each other. We ensure like reserve bounds and all these kinds of things. And then you also have a contingency pricing mechanism, which is what I'm going to talk about now. Right, I'm going to talk about that. The first thing I want to do is make an abstraction and ignore the fact that there are different assets in this reserve and that you have balancing. But instead, the model is basically you're ignoring that the fact that they are different, and you're saying I have a thing and it's worth a certain amount of dollars, and I can give it to someone when they're redeeming a unit of stablecoin. And now the question I'm asking is, how should the system do this if it's not fully collateralized? Let's say there was some kind of shock to the assets, so it was over collateralized and become under collateralized. Now it happens. And the model we're using for this is, or let's say a framework or analytical tool, is what I call a redemption curve. This is a curve that happens where we assume we start at some market price and at some level, some collateral value. And then on the x-axis, I put the redemption level. So that would be, you can think about this as the percentage of assets that are being redeemed. So up here, there are just no tokens left. And then on the y-axis, I'm putting the price. And ideally, of course, this should be a horizontal line, but if it's under collateralized, we don't have enough assets to make that happen. So that line has to curve down in some way. And higher curvature, of course, means that you're dropping the redemption price more quickly. And that's the main design tool. One thing you could do is, well, we redeem at exactly $1 until all the reserves are exhausted, and then we drop to 0. But we think this is not very good for a couple of reasons. The main reason being that when the system does that, first of all, at some point, you're not supporting your price at all. So the price could crash to 0. And then the other one is if you're earlier, you redeem at 1, and at some point, someone else is left holding the bag. So that's pretty bad incentives. And so we want something more clever there. You also observe something that looks like this in the real world. This is a very, very famous case of George Soros' attack on the pound in the 90s, where the central, the Bank of England, was supporting the price of the pound for a while until they didn't exactly run out of assets, but they decided it was too expensive, and then the price of the pound crashed. You have these phenomena there. Another case study I want to think about is Pay, for example. So Pay had this design with direct incentives, which essentially meant that as people redeem, because people redeem, the price is being dropped. But what this means is, of course, that you have a redemption curve that curves downwards very, very quickly. And that, in my opinion, led to more volatility than could have been there. There could have been a better design. I have one favorite example, which is tenured shares. So tenured shares, right? You think about something like USD. Someone comes to you, and you are creating out of nothing your volatile asset, and you're redeeming your tokens for that. And essentially, what this gives you is you're observing the market price of your token. So technically, you're making sure that in that moment you're redeeming for $1 worth of assets. What's going to happen is that at some point, the demand for your volatile asset in the market is just going to be exhausted, and then you very quickly crash down to 0. And of course, there's like this case of UST. So we had like pretty good stability of both assets, more or less, until it crashed very quickly earlier this year in May. And keep making this joke that's funnier when this line just pops up. So this was the date where I first gave the version of this talk, and also mentioned Luna. So like you can raise an eyebrow and ask like coincidence. There was a precedent to this, which was Iron, for example. So it worked exactly the same way. You had like Iron, the stablecoin, Titan, the backing. And at some point, it just basically disappeared. So now, of course, like I gave you all of these examples. Now I probably want to talk about like what's the better design. MD.
Thanks. Question: are you familiar with Ampleforth?
Isn't that this rebasing system? Is that the?
Well, it's kind of it's an interesting system. I mean, I don't want to get into it, but it's like elastic, right? Like it decreases supply when it's above peg, and it increases supply when it's below peg.
Right, but
is really that
works like the balance in your wallet changes?
Yes, 100%.
Yeah.
Anyways, it's been going. I mean, it's survived all the chaos and stuff. It's interesting to see, right? Anyways, I don't want to interrupt. Keep going.
Yeah, no. It's like, okay, so I mean, I'm familiar with the design. Like, not like super deeply, but I understand what's going on, I think. I find this very confusing, because it kind of questions the value of like money, like what is money? And I think one property that you want to have is that it's not the case that suddenly you have less of it. Like that shouldn't happen. But yeah, you're still raising your hand. What's this like mistake, or you want to respond to this?
No, I always just forget to lower my hand after. It's my fault. Sorry.
Yeah, no worries. Yeah, right. Money means trust in the asset. Yeah, right. So I know if the system comes, like kind of randomly comes to you and takes your money, I wouldn't use that. Right. So now, what could this primary market look like, and in Gyroscope? And so I kind of want to proceed in 3 quick steps. The first one is kind of thinking about, I want to start with the redemption curve. Like what kind of redemption curve makes sense? That's the best you can in the situation. Then I'm going to show you one such curve that we use in Gyroscope. And then I'm going to talk about implementation. And essentially, this is the task of creating a dynamic bonding curve from the thing we want to see. Okay, so good properties of a redemption curve. We're just listing a few. Ideally, collateralization should be above a lower bound that governance sets for the system. But this, I mean that the design of the redemption curve should not itself make the system drop below that collateralization level. So, for example, the first one I showed where you redeem at 1 and then you're running out of assets and then you redeem at 0, that's not what we want to have. There should be some kind of lower bound there. The same should be true for redemption price. Normally, of course, redemption price should be 1. I think the redemption curve should be continuous and not too steep. The main reason for this is because if you have discontinuity, it always creates these incentives to try to target the discontinuities and trigger the discontinuities, and that's kind of up for incentive misalignment. And then one nice property is that while you're doing that, you shouldn't create incentives to subdivide your redemptions, because that makes it complicated for everyone. Some more, let's say, wider desiderata that we want across blocks, a bit more vague. Reserve exhaustion should take a long time, if possible. And one of the reasons for that is that we want the system to recover afterwards. When the stablecoin has depegged, there should be some kind of option to regain its peg. I guess that's clear. And then we also want to be able to implement it, obviously, because the whole thing has to run on chain. Now what I want to do, the next step is I want to give you a redemption curve. And the assumption here is that we assume at first a static framework. So we assume we start at some point in time, then some kind of redemptions happen, and we think about how should the system behave. Of course, in reality, and while we're doing that, we're assuming that the value of the asset doesn't change. Because in reality, we don't have that luxury, and we need to respond to every state, like the current state of the system. And I'm going to show you how to do that. But for the modeling phase, I'm assuming we start at some state, reserve has some value. How should the price change? And this is also why, so in reality, we are measuring the amount of redemptions at any point in time using this formula, which is time discounted sum. So this is more of a redemption pressure. But for now, you can think about it as just the percentage of assets that has been redeemed, which is also this one when redemptions happen very quickly. And let me skip over this and show you the actual curve. And this is the actual curve. So a bunch of stuff here. Essentially, what we want is that as long as redemption pressure is low, what the system is going to do is allow redemptions at $1. And the reason for this is that there's kind of this trade-off between short-term tight peg of the stablecoin and long-term survivability of the stablecoin. And the system's going to make a trade-off between the two. But at a time where the redemption pressure is low, maybe the stablecoin has very high economic value for people, so they are not even redeeming. The system is going to allow itself the luxury of keeping redemptions at $1. Of course, this will support the price for a while. And then what the system is going to do, there's going to be a point, and this point is computed dynamically based on a few parameters. At that point, the redemption price has to go down somehow, and well, we just said it's going to go down with some slope. And then we're going to hit another point, and this is the point where the system collateralization is equal to the redemption price, and this is where the redemption price doesn't have to go down anymore, but we can now keep it constant. So, I mean, if we kept our line, it would go down further. We don't have to do this, so we keep it constant here. So now, how are these points chosen? We observe a collateralization ratio that happens at redemption amount 0. This is what we call the anchor collateralization ratio. So again, in reality, of course, you don't observe that, but the model is like this. And the system has 3 parameters. The first one is a lower bound on the collateralization that the system should keep. So that's basically the height of this line, the y value of this line. It has a lower bound on the slope of this segment. You can leave that out, but then the whole thing kind of degenerates into something that only has 2 parts. And then there's an upper bound on this point. And based on that, what you can do is so this fully specifies the other 2 points. So it specifies how long the system can offer a redemption price of 1, and also specifies where this curve has to become constant again. I don't want to go, we briefly want to flash the math, so you know what the math looks like, and it looks like this. So this little alpha here is the slope of your line. This xu is the point until you redeem at $1. This is the point where you can be constant again, and this one is the price at that point. And so like the reasons why these are the right equations is like you can solve it. It's not that hard. But what you're seeing here is that these are not very hard to compute on chain. And we have some case selections, and these case selections are going to be important in a moment. Now, once you have that, the problem is that this point here, you start at some anchor reserve ratio, and then based on that, you can compute like this point and the slope and everything else. Like that point doesn't exist, right? Because your system has to react to whatever is going on in the moment. You don't have an anchor rate. You also can't really look back into the past, because who knows, like the market state has changed or something. So what are we going to do? And essentially what we're going to do is we're observing the current state. And what we're going to do is we show that there's only one such starting point that is consistent with the current state if we assume the model. And then we just compute that starting state, and then we compute what happens afterwards. So why would that be true? There's like a very simple math statement, which is the following. So if you put the anchor reserve ratio, is basically the height of the starting point, on one axis, and then you put this amount, which is the amount that has been redeemed, which I call x, on the other axis, and you put the reserve ratio or collateralization ratio on this axis, then you get a monotonic function. At least in the part that is interesting. Of course, it becomes that at some point. Okay, and why is that true? Well, you do like a bunch of math and compute derivatives, and then you see that all of them have the right signs, and then you prove this. And so also what this means is that this is actually strictly monotonic. also what this means is that because of this, when I have a current collateralization ratio, so that would be the height here, and the amount that has been redeemed, which we can observe, then I can get back the value on this axis, and then I'm done. Okay. Now, kind of if I have a lot of computation, I guess I can just model this function into a grid. Like I can actually virtually plot this and then just figure it out. But of course, we don't have that luxury on chain at all. By the way, I'm noticing I'm going like 5 minutes over time or something. Is that fine with everyone? Yeah. Okay.
Yeah.
Okay, cool.
Yep.
So right. So on chain we don't have that luxury. So what we're going to do is more math. And essentially what we can do is we can look at all of these case distinctions here. And what you're seeing is that when you know in which combination of case distinctions you are, the equations are not that complicated. And maybe if I tell you in which case you are here and here, then you can write down the equation for the solution of the system. And I mean, we have like a square root here and like a fraction there, but maybe it's not so bad. And maybe it's possible to write it down as an equation that is actually analytic, and that's actually true. But how do you figure out the different cases here? And so essentially what we can do is we can make the chart much more complicated. And what I have written down here are, for each of the different case distinctions, I have labeled the region where this case distinction has like one case or the other case. So I forgot which one. So this is essentially what it is. And so we can split this three-dimensional chart up in these regions within which computation of the starting point is somewhat easy. And now what I have to show you is that we can actually know in which region we are. And so this is just stated as a theorem here. If you want some intuition for why this would possibly be true, essentially the idea is that you have some boundary lines which are marked here. And these are anchor reserve ratio where we are exactly at the threshold between these regions, and they are very easy to compute. And what you can do is you can compute the value there and then compare to the current reserve ratio that you're observing. And that tells you in which region you are, and then you need to do some other things, but not too much. And then you know what exactly your case distinction are. Once you've done that, you're basically done. And if you believe me, the thing I said before, then our algorithm for the system to figure out for how much it should redeem tokens in under collateralized state is we go and detect the region of the current state. We reconstruct the anchor reserve ratio. And then based on that, we can compute the redemption amount because that has fully specified our redemption curve model. And now this is very complicated to describe, but actually if you count, you only need like 2 square roots to do this. I have you're all nodding, it's amazing.
I have a little silly
yeah.
question.
Yeah, absolutely.
Could you hard code the anchor rate to something like 1?
Well, if you do this, then the system wouldn't take into account its own current state. And that means that the prices you're offering for redemption wouldn't have any of these nice properties. For example, but if you hard code it to 1, then what the system is actually going to do, so this curve, when you put the the starting point up to 1 is actually going to converge to a horizontal line at 1. And so if you hard code this at 1, then the system would degenerate to a system where it offers redemption at a price of 1 until it runs out of money, and then it's gone.
Interesting. Yeah.
You can try, I guess you can try hard coding it to some other value. And then I guess you always get some variant of the system that, let's say, follows this curve until it notices, oh, I'm running out of reserve, and then just drops to 0. I guess, yeah, I guess that's probably true, right? If you hard code it, at some point you always have, depending on the actual state, you always have a point where it just runs out of money. Or if you hard code it too low, then it may actually lead to a situation where some assets are locked into the system because the system thinks it's like very severely under collateralized, let's say 60%, right? But it's actually 80% under collateralized, so it drops its redemption price. But then what do you do with the rest of the assets?
Yeah.
I guess governance will just go and grab that one. Yeah. Right. I have some like properties here. You can like show some properties of the system. For example, we actually do have this nice property that there's no incentive to split up redemptions. You actually have path, like complete path independence if you are not asking for any fees or you don't have any gas costs, then it doesn't even matter if you split it up or if you keep it all together. If you have fees, then the protocol state only improves across mints of, so people who like mint and redeem, then the state of the protocol is going to go up and up because of these fees. Right. Yeah. Thanks a lot for having me here. Despite the interruption, I really like giving this talk. So I talked about Gyroscope. I talked about the stablecoin GYD, the ECLPs. Talked about a bit like why we built this. Talked about the launch, and then I dived into the dynamic stability mechanism and all of the math that is complicated to write down, but actually fast to run. That makes sure that the system can handle itself in the event of under collateralization. And so just the final word on this, and what the motivation for this was. Of course, sometimes when I give this talk, people are like, oh, so the system is going to be under collateralized or what? Like, why do you even have this? Like, of course, it's not supposed to be under collateralized, but what we think is that there should be clear rules what happens in every situation in the system, right? And if the system has a clear rule what it would do in the event of under collateralization, then that makes it like more trustworthy, or more reliable, and hopefully more successful. Thanks a lot for your attention.
Cool. Yeah. Thank you so much for coming to speak. Actually, I've been a huge fan of Gyroscope since seeing your earliest work. I mean, a number of years ago, I was playing with a lot of the testnet stuff. So really, really great to see the progress. Congrats on the launch too. I had no idea it was so recent as well. I'm gonna go dive into some of those pools and see what's going on there. It's super exciting. So I think this is like, as the Bonding Curve Research Group, like we are all about, the proper contextual application of these tools. And in my view, like Gyroscope is one of the most thorough, well-researched, multi-asset dynamic stability. Like really, it's great. It's great. So yeah, I'm really excited how we can leverage those patterns as well, where we can, utilize GYD as like a reserve asset, even with all of the reserve assets backing that. We talked a lot about early bonding curves. We'll use DAI, but DAI is one asset again, and the correlated risk and whatnot. So I'm really curious how we can also like leverage this in other diversified strategies, knowing that there's sort of these baskets underneath. So yeah, really glad to have you speak, and I'm looking forward to the next few presentations as well, so we can dig in a bit deeper.
Thanks a lot for this, MD.
Oh, if I could just ask a final question, if that's okay.
Yeah, of
I
course.
noticed in those in with that one pool, I guess I kind of look at it as a stability pool, the 5 diversified stables, you know, DAI, USDC, USDC. But then I noticed how
Mhm.
you had LUSD and Curve USD. And
Right.
could you take 2 minutes to explain why you chose
Right.
those 2 stables to include? Thanks.
Yeah, of course.
And I appreciate your talk today. Thank you.
Sure, sure. So let's maybe take the picture that's like a little bit, yeah. Right, so why do we have LUSD and Curve USD in there? And so the motivation for the reserve choice was diversification mostly, and diversification and a little bit stable yield, but mostly diversification. And so what we thought about is the first thing, we have other stable coins in there, but let's view stable coins as a risky asset. Let's obviously not just put them at one, because otherwise why would you even do this? And then think about the different risks that they are exposed to. This is like a certain price risk, of course, lateral risk, but then also geographic and regulatory risk. So for example, one diversification choice was USDC is US-based and Tether is not. So there's some, let's say, geographic diversification there. Then, of course, you have like indirect effects. So DAI is now backed by real world assets, which at least partially also seem to have some US connection. So it's not like literally splitting up into completely independent systems. I would say that's never really possible in an economy. But like to the extent possible. And so the reason why LUSD and Curve USD fit into the mix pretty well is just a significant independence of these custodial stable coins, because I would say especially LUSD is, I mean, it doesn't even have governance, it's only backed by ETH. So there really should be a significant separation and diversification there that we can use to make the whole system more diversified and more stable. Maybe the other thing I should mention is that LUSD and Curve USD are in the same pool. And of course, as soon as you provide liquidity between these different assets, what you're actually doing is you're merging the different risks, because if one of them crashes, you're always ending up with the cheaper one. So what we also were careful about is that it's less risky providing liquidity between assets that are exposed to the same risk, other things equal, because you're already exposed to those risks in one asset, and then you can expose yourself to the same risks in another asset. And well, according to some kind of math, you're not taking on additional risks that weren't there before. That's certainly, let's say other things equal, that's certainly less risky than providing liquidity between something that's exposed to this host of risk and then this other host of risk, and then at some point you're getting them all. And so we also thought, well, LUSD and Curve USD seem to be exposed to otherwise also similar risks, because they are both very on-chain projects, so they are both exposed to all of these, let's say, on-chain things. Curve USD is also based on over-collateralized vaults, also including ETH. So to us, those are the reasons why it made sense for us to make it like this. Have an additional separate set of risk factors in these two coins, and then have somewhat similar risk factors in the two coins.
I should have prefaced it. I mean, I think it's really, really cool feature. You know, the decentralized nature of them and just their design. Any consideration adding Frax?
I think I said what I wanted to say about Frax. So right now, probably not, mainly because of this under-collateralized or endogenously collateralized nature of Frax. Yeah.
Yeah. Okay. Thanks.
Great. Thanks, Steffen. Thank you again. Thanks everyone for joining today. And we're gonna have a follow-up session this Thursday for session number 2. And
Awesome.
then I believe session number 3 probably in the new year. I don't think we've scheduled that yet.
Yeah, I
Yep.
think it's not scheduled yet. Yeah.
Yep. Okay, so we'll see you all back here in 2 days. The
Cool.
time slot is, I believe, 1 hour later than it was today. And
Yes.
yes, with less disruptions in that session.
Yeah, exactly.
Yeah. Oh, great. Thanks, everyone.
Thanks a lot.
Thank you.
Bye.
Thanks, Steffen.
Thanks, Steffen. See you again next time.
Thank you. Have a great
Have a
day,
Good day
everyone.
all.
See you
Yeah.
guys. Bye.